Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about long-term debt, and we've done some really fun transactions, right? With the straight line amortization method and effective interest method and all the fun stuff that goes along with long-term debt. Now we get to transition out of long-term debt and into equity, which is the last piece of our balance sheet discussion and this first module of our semester talking about liabilities and equity. We're going to break our discussion of equity down into several pieces. You can see them here on the screen. Lots of cool stuff that we get to talk about with equity, and the good news is that even though it looks like a lot, it's not super challenging. FASB has kept the rules for equity accounting really straightforward and simple because that's what investors, i.e. owners, really want to see. Straightforward statements about what they own. To start off our discussion about equity, I want to talk about why we care about equity financing and the records that we have to keep for our owners. The reality is, that's the whole point. Businesses exist not to pay back debt. They exist to make money for the owners. That's the purpose. And because of that, the accounting cycle developed to show owners what they own and how what they own has changed over the life of the business. So really, everything we've done up to this point is about sharing with the owners what they really get. Even when we keep track of debt financing, it's part of showing the owners, you don't own this piece, they have claim on these other assets, and you're going to have to pay them interest, but what's left over, that belongs to you. The other thing we'll talk about with equity is paying them back. Just like debt holders, equity holders want their money back. They don't want to give us their money and have it stay with us forever. So dividends and withdrawals, that's our way of giving back to our owners the money that they've put into our business. Now there's lots of different ways that we can measure how we're doing for our owners. Profit margin is a way that we can assess value for our owners. Earnings per share is an assessment of how we're doing for our owners. But usually the most common and most popular way of really assessing how our owners are doing is to use return on equity, or ROE. Now to calculate ROE, we take our net income, we subtract the preferred stock dividend that goes to these pseudo-owners that don't really have voting rights, so they don't really count as owners per se, and we divide by the average total equity. And that result tells us how much we really have left over for the owners based on what they put in. Now, since it's so important that we keep track of equity and how we're doing for our investors, etc., let's go back to the beginning and talk about the very basics of equity financing. Remember that companies are funded in two ways. One is debt, and you remember we drew our little banker to represent our debt. The other is equity financing. The money given us to the regular individuals who want to own a share of what we do. Now, debt financing consists of two different pieces. There's the cash that they give to us, that we have to track, and we have to give that back to them. And then there's the interest that accrues over time as the loan matures. And sometimes we pay that back as we go, sometimes we let it accumulate, sometimes we're paying the loan principal and the interest at the same time. But these are the two things we keep track of with our debt financing. And on our financial statements we show, here's the money we got from our debt holders, here's the interest that's accrued, we add them up, and that shows the total amount we owe to these debt investors. Equity also consists of two parts. Again, there's the money that they've given to us. We call those their investments. And then there's the retained earnings. So at the end of every period, we calculate a profit, a net income. And we have a choice with that net income. We can give it to the investors. That makes them happy. Or we can keep it in the business. And that means the equity holders are sad. They're sad because they don't get the cash. But that portion of the business that we financed with these retained earnings and these profits coming in, it belongs to the owners. And later on, they're going to be able to withdraw it, either by getting a dividend or making a withdrawal during the life of the business, or when we finally close down the business or sell it to somebody else, then we get all of those assets back. Either way, those owners own those assets. And it comes back down to that accounting equation. Normally we write it as assets equals liabilities plus equity. But for equity holders, it's really equity equals assets minus liabilities. So what we're tracking here are the assets that the owners own. Some they own because they put them into the business, some they own because the business has grown, and those assets from growth belong to the owners. Now, through most of the semester, we have focused our discussion on corporations, and we do that for two reasons. One, because it's what you've seen most often. Usually earlier accounting classes focus on corporations too, which means it provided some consistency. The other reason that we focus on corporations is that most of you, as you leave school and get started, will focus on corporations in your business. Either you'll be working for a corporation, or you'll be auditing a corporation, or doing taxes for a corporation, etc. So there's been a reason to this focus on stock as opposed to other kinds of ownership. But the reality is that there are lots of different styles of business, and the accounting is just a little different for each one. The first type of company is a sole proprietorship. This is a company that is owned by just one person, and he or she is responsible for everything that goes on in the business. Now, he or she may hire individuals to do some of the work, and managers and supervisors, and it can be a rather large business. So it doesn't mean it has to be small. It just means that ultimately only one person owns that business, and all of the equity belongs to him or her. The next type of company is a partnership, which is owned and typically managed and run by a group of partners, and each partner owns a certain percentage of the business. Now, my favorite story about partnerships actually comes from my very first consulting job as an accountant. I was taking a bookkeeping class in my first year of college, and my uncle had started a small business and asked me to come and take a look at his books and see how they were doing. So one day I came back from school and met with him, and we went through his books, and as I'm going through his financials, I realized that he has listed all of his partners as liabilities. All of them. Now, I don't know what kind of a signal he was trying to send to his partners, whether this was because he misunderstood the accounting or because he thought they really were keeping him back. I don't know. All I know is that that's how he had listed them, and I could not talk him out of moving them back into equity. No idea what he was trying to say. It could just be that he legitimately wanted to pay them off and make his business into a sole proprietorship, but who knows? I decided to just walk away from that one and let him and his partners work it out themselves later on. Now, our last type of business is the one that we've discussed over the course of the semester, and those are corporations. They're owned by a lot of investors that really have no say in day-to-day operations. They vote on the board of directors. The board of directors votes on and selects the CEO, and then the CEO and the rest of the management team takes care of the day-to-day stuff. But corporations have become very popular, number one, because they spread out the risk. If things go badly, I'm only on the hook for a little bit of the money. And two, because of the legal protection. If things go badly for a proprietorship or a partnership and you get sued, in a lot of cases, they can not just take the assets of the business, but they can go after your personal assets as well. In a corporation, the corporation is considered a separate entity. So legally, if something goes very badly, the stockholders are off the hook. Now, the good news is everything we've talked about up to this point, everything, is the same for partnerships, proprietorships, and corporations. We treat the assets the same, we treat the liabilities the same, all of the accounting cycle works the same. The only difference is here at the end in the way we keep track of the equity of the company. We change what the journal entries look like. So instead of having a common stock account, I would have a Jason's equity account, or a John's equity account, or a Carrie's equity account. One equity account for each owner. So proprietorship, just one. Partnership, unless you're my uncle, there are 2 or 3 or 4 or however many partners there are. And as the business grows, the owners get that increase into their equity accounts. In addition, a corporation has a dividends account, and we've talked about how once a dividend is declared, they're legally obligated to pay it, and so they have a dividends account, a dividends payable account, and the owners can't just walk in and say, you know, I own 10% of the business, give me $5,000 in cash. They can't do that in a corporation. In a corporation, the board of directors chooses when a dividend is going to be declared and paid. But in a sole proprietorship or partnership, the owner can just walk in and say, I want some of my money. And as long as his partners or her partners have no objections, he or she can just walk out with it. And that happens quite a bit, especially in sole proprietorship. We see this a lot, where the owner will just take what he or she needs out of the business, and the accountant just makes an entry to a withdrawal instead of a dividend. But same idea, assets of the business are being given back to the owners. Now, the other difference between the journal entries for sole proprietorships and partnerships versus corporations is that we don't typically keep a retained earnings account for a sole proprietorship or a partnership. Instead, we put all of those retained earnings into their one equity account. In a corporation, we keep the two pieces separate. We keep the investments in a common stock account, and we keep the profit that's been kept in the business in retained earnings. Now, as we move on through the rest of this chapter, we're going to stick with our focus on corporations for the reasons that we talked about before. You're going to spend probably the first part of your careers working with corporations, so you probably ought to be very comfortable with how those journal entries work. We will show in a couple of places how the entries would look if we were talking about a sole proprietorship or partnership, just so we can see the comparison. But the good news is the journal entries aren't very different. It's really just the way we write out the account names that changes. So with that as an introduction, we're ready to start talking about some examples and some specifics, and that will come in our next segment. I'll see you then.